Evening, everybody. Ooh, it's 3 minutes after. Sorry about that. All right, I was going to do the stop loss session tonight, but I realized that if we don't kind of, what do I want to say, prelude it to why we're getting in and out of positions, that it makes that we need to do that to get a little bit more confirmation of why stop losses can be placed effectively. So this is just kind of a rhetoric to kind of get everybody in the frame of mind that our entry and exit strategies are based upon our first priority, which is finding the best possible trades. And then once we find those trades, we need to know how to enter those trades and exit those trades at the optimal time. So some of that's going to include, or all of it's going to include, common sense analysis. First of all, we want to know, what do the candlestick signals tell us, and has there been a change of investor sentiment? So with our studies of the candlestick charts, hopefully we can see what should be a possibility of a entry strategy. And if we can see the obvious setting up that we have a big hammer type signal right on the 50-day moving average, what do we need for bullish confirmation? We need to see that the bulls are there. Not only that the bulls are there, but in this case they were there with great enthusiasm. So that tells us that we want to definitely be buying, especially after a candlestick signal. So if we go to our very basic premise of what are the candlestick signals, it's pretty much that there should be a change of investor sentiment, and then we want to see confirmation that that sentiment has changed. So when we're entering trades, a lot of people say, well, how do we enter the trades when you say on a positive open? Well, there's 4 possibilities for getting into a trade. And that's based upon how the market opens and how the stock opens. So if the market opens higher, like we're anticipating, let's say we're anticipating the market being an uptrend, and our stock price opens higher, that's probably a pretty good situation we want to be buying immediately. If the market opens higher but our stock price opens lower, that means the bullish sentiment isn't there, but that could also mean there's some profit taking on the open. That makes for a very simple entry strategy. Whoops. I have these explained here. Market opens higher, stock price opens higher. Whoops, we did that wrong. Stock price opens lower. Then all we have to do is wait for the stock price to come back up through the previous day's close. That's a good indication that they had some profit taking on the open, and the bulls were stepping right back in again. If the market opens lower and the stock opens higher, we don't have to necessarily be buying immediately. We can wait a few minutes and see what the overall consensus is in that individual stock price based upon the market opening lower. If the stock continues to show strength, even though the market is weak, then it can be bought, because that pretty much tells us they're buying that stock even though the market is opening over. And the other scenario is if market opens lower and the stock price opens lower, it's just telling you this is not time to be buying right now. There's no buying force in the market. So again, this all comes back to very simple common sense. What is the investor sentiment going to be? If we see a bullish signal, what do we want to see the next day? We want to see bullish confirmation. So once we have that established as that's the reason we're buying, where we see a buy signal and bullish confirmation, then we can pick up situations that tell us where is our common sense sell signal, or where should we be selling. This is where the T-line comes into as a very important buy confirmation. If we see a doji gap up, that's number one, a very strong buy signal. Number two, if they close it above the T-line, that's even more confirmation that the uptrend's in progress. So what we don't want to see is we see a potential buy signal, what do we need to see the next day after a doji? We need to see it open positive. If it opens lower, that just keeps us out. Yeah, somebody might want to type in for Ed to close out and come in again. There you go. Thanks, Fernando. So this is what keeps us out of trades that aren't working. That if we know the simple rules of our signals, that after a doji, very simple, it's going to move in the direction of how they open it. That keeps us from getting stuck in a position where we might be stuck in it for days or have to come right back out of it. It just doesn't confirm. Now, what are we anticipating in this situation? We're anticipating a J-hook pattern. So number one, if we were out of the trade and looking to buy, we definitely want to be buying on the positive open. If we're in the trade, what are we anticipating? That this should support on the T-line, but we still have a very simple rule, the doji. If it opens lower and starts trading lower, close out the position. If you're still anticipating or thinking that it might turn around, pick out a spot that tells you the bears are in control. If they open it lower after a doji and start trading it back down below the low of that doji, that's time to get out of that position. What's the worst case scenario? Worst case scenario is they take it down, and at the end of the day, they bring it back up. You can always buy it back as it's coming back up through the T-line. Yes, that might be server problems. If we see a situation where we had a left-right combo and it opens lower the next day, this is where we just kind of wait and see if they bring it back up through the previous day's close. That's when you want to be buying for two reasons. One, because we have a bullish candle. Two, when they opened it lower, we didn't know which way they were going. But if they start moving in this direction, at least you know you're buying it in the direction that you're expecting after a bullish signal. This is recorded. The T-line, Alan, is the 8 exponential moving average. That is probably the bellwether of all our moving averages. On here, on this chart anyways, we've got the 50-day moving average. The pink, I think, should be the 20-day moving average. And then there'll be a red line, which is your 200-day moving average. And those are all because that's where all the major money managers make their decisions. What we want to use is the T-line, the 8 exponential moving average, because it's got a very simple concept. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. And the caveat to that is if you start moving too fast, too far away from the T-line, start watching for a sell signal because they're more than likely going to come back to the T-line. And, so once we see this buy signal set up, it's just very simple. We want to see bullish confirmation. Now, this is where the halfway point is very crucial to candlestick analysis. And again, that's just common sense that the Japanese rice traders have illustrated for us, that if this happened to be the candle that told us the bulls were in control, what would be the point that would tell us that the bears are back in control? Well, if the bears could close it back below the halfway point of the candle that told us the bulls were in control, that means the bears are still in control. You want to be back out of that trade. And I say that because through years of, unfortunately, hard knocks experience, I saw the bullish signal, and then it would negate the next day. And I'm thinking, well, I saw a bullish signal. Maybe I'll stay in. Worst case scenario is that if you close out the trade and then it opens positive the next day and confirms your signal, you can always get back in. Because what I've discovered is for the few cents or 30 cents or $1 that I've given up by getting out of a trade when it looked like it was time to get out and getting back in when it looked like it was time to get back in, that little bit was just insurance that I wasn't holding on to something that was going the wrong way. And I wasn't getting into a trade for 30 cents or 50 cents or $1. I was hoping off of this move we'd have a $7, $10, $15, $20 move. And that's the type of moves I'm looking for. Not worrying about the little pennies of making sure I'm in the right trade. So again, this is what we don't want to see on the next day. We don't know whether this is profit taking or still weakness in this downtrend. So if they don't open it positive the next day, or if we happen to have bought it up here, anticipating they're going to take it up, they shouldn't close it more than halfway down this candle. It's time to get back out of that trade. Yeah, this pink, I can't remember. Some of these charts are a little bit older. And this is the problem too, or not the problem. This is what keeps you out of waiting for confirmation on an entry strategy. Is if we see a bullish Harami, what do we expect to see the next day? We want to see that they open positive and trade positive. If they open it down here, that pretty much tells us the bullish strength isn't there yet. We don't want to be getting in until we see the bullish strength being confirmed. Again, what do we want to see? This is what keeps you from executing a trade. If we're expecting a perfect buy signal situation, like a bullish Harami right on the 50-day moving average, and it opens slightly positive the next day, I usually say I'm going to buy immediate. Well, my immediate may be 30 seconds, a minute, 2 minutes, 5 minutes, 10 minutes. If this opens, and you can see immediately they're selling it off, which we can see because we can see the candle forming another dark candle, we don't have to be jumping in until we see that the bulls are there. And in this case, if it opened positive and started trading negative, all we have to do is wait for it to turn around and come back up through where it opens, because if it did that, that tells me the bulls are taking control. On the other hand, if I bought here anticipating that things are going to move positive, this tells me that this signal that told me the bulls are in control was completely negated by this signal telling me the bears are back in control. So the reason I illustrate this is we're not going to make money on every single trade. We're not even going to hit the right hitting in the right direction on every trade. So if you have that in your mind, that 3 out of every 10 trades are probably going to or have a high probability of going against you, just look at a chart and say, man, I got into this, but it's not doing the right thing. Just tell yourself, this was part of that 30% that told me I shouldn't be in here anymore. Go on to the next one. Now, I say 30% because for years, because I was smarter than everybody else, that when I put on a trade, it's because my analysis, my own mind said we should be going in this direction. And when it went that way, I'm thinking, no, that's because everybody that's not as smart as I am doesn't see the logic of why they should be buying right now. But remember, the market doesn't give a hoot what you think. What we're trying to analyze is what is the market doing, or what is the price doing. And when it goes against you, close it right out. Let's see. I don't know. Let's see. Oh, and sometimes when you get some selling, but it's not really a signal, and your stochastics are heading up, that should still keep you kind of in the process of the signal telling you that you're still in an uptrend until it's kind of a belt hold, almost a piercing signal, that you stay long until you see that signal negated. So here's the logic of our bull entry. Notice when it opened positive the next day, it traded down here. But what did it do from here? It gapped up. So even though it gapped up and traded down, we might not have bought it, but we still have to have in the back of our mind that they opened this positive after a doji. The next day when they take it right back up again, this is why you hear me often say this trade has to open positive and trade positive immediately. That's the kind of thing that would get you back into this trade or into this trade based upon this was a gap up profit taking, and then the profit taking's over, you're starting your uptrend. Here's another case, too, where this looks like it's time to be buying. If I was going to use this to say I'm going to buy on positive trading and it opens down here, it makes my entry very simple. If they brought it back up through the previous day's close, I can already see there's a second green candle forming and that they're moving in the direction that I expect it to be moving, which is positive. So then I know where it shouldn't close. It shouldn't close back below the halfway point of this candle, which would obviously put us back below the T-line as well as the halfway point of this candle, which tells me there's not a lot of strength there. I want to be back out of the position. So what is the best thing that we want to see for confirming a signal? We want to see bullish confirmation. And your best bullish confirmation, as I mentioned today in the chat room, I've just finished updating all the gap videos, so that we've now got more clarification on how to use gaps at the bottom and how to use gaps at the top. And the reason gaps are probably your most powerful trading friend, I guess would say, is because if we see what is going on in a candlestick reversal signal and a gap up, we know if there's a gap up, there's a lot of force in that new decision, and that force is usually going to create a very strong price move for us. So if we're buying down here or we're buying here and we're seeing bullish confirmation, we can always see where our target is. And this was a very easy chart to stay in because of the T-line, because we knew where our target was. Now, once we get up here, now we can start watching to see what type of signals that are going to occur when we get up here. Now, there would have been a case down here that said, all right, it's time to close out this position because it closed below the T-line. If it was the first time, we said give it one more day, and it closed back below the T-line. That's pretty much telling us it's time to be out of this position. However, it's also telling us the next day when they gap it up and do kind of a trend kicker signal, back up above the T-line, we can always get back in. Now, that's easy to say on hindsight, but what that kind of dissipates is, like in my own case, I would hate to sell something here and then see it go up further. I keep thinking, I'm not going to buy this back because what if it went back up and turned right around and went down again? Boy, would I look stupid if I sold it and then bought it back and then sold it again for a loss a second time. But what candlestick analysis did for me was, if these were all our trading rules, which aren't that difficult, as long as it's trading above the T-line, you want to be long. But if I see where they've pulled it back and they've just closed below the T-line after an extensive uptrend, and then I get out of a position, now I can get back in with great comfort, knowing that as long as it stays above the T-line. Harvey, yes, we do scans for these. Everybody in the chat room pretty much has different scanning techniques, and I use Metastock and TCNet. And we will be doing a scanning session for members on February 1st, which is a Saturday. And we will go for about 2.5 hours, and that will all involve, first of all, how do we analyze which is our best trade. So we're going to kind of go through the best trades quantified, and then how we set up our scans. And then once we've done our scanning, how we pick out all the good stocks. And then if we've picked out good stock positions, how do we sort it down to the best one or two for the next day? So that's going to be a 2.5 hour session. And again, that's free for members. As a matter of fact, because we're getting a good number of people in, we will probably be limiting a lot of these training sessions now to where we used to have non-members paying for the sessions. and the members free, but we'll probably now just keep it where the members only. So anyways, do you put a physical stop ASP right after your entry? If so, do you put the stop just below the T line? Sam, no. It's all based on where would be the situation, or where would it be that would tell me that it was time to be out of the trade. Sometimes that's going to be above the T line, and we'll get into that as we go through this. Other times it'll be, the T line will be a factor. If we've just bought a candle signal that had a bullish signal confirmed by closing up above the T line, and the next day it opens positive, it better not close back below the T line. If it does, we're back out of the position. Now, remember, the important factor that has made candlestick signals is the open and the close. Anything during the day is just noise. So we want to see it close below the T line. Now, does that mean we might take a little bit bigger losses by waiting to the end of the day to see if it's actually going to close below the T line, and it may go down a little bit further? Yes, that's a good possibility. But the probabilities are that if we're analyzing a trend, and I'm trying to find something that would kind of show that sometimes they come back down below the T line. It's not here, but I'll get to one. But we have to wait to the end of the day, because a lot of times they'll trade back below the T line. But if we're in an uptrend, all it is profit taking, and by the end of the day, they bring it back up above the T line. So is there a added risk for waiting to the end of the day? Yes. But the probabilities are that if you're in an uptrend, that the trend will still be moving in the same direction by the end of the day. How do you use stochastics to confirm candlesticks in T-line? Stochastics, again, 1233. Oversold, we're looking for buy signals. Overbought, we're looking for sell signals. Except when we see a pattern, candlestick or the stochastics will probably be in the overbought condition when they break out through a trade area. So this is knowing that we can buy immediately on a breakout based upon what we saw prior to this, which was the candlestick fry pan bottom. Yeah, hold the questions to the end. Not that I'm ignoring them. So I think we're going to be here for a good while tonight. We're already 25 minutes, and we're not even 1/10 of the way through. So if we know the simple rules of entering, we also know simple rules for exiting. So if we see a doji, we know if it opens positive, we got a doji sandwich. Same scenario. If we see a doji, it needs to open positive. If we happen to have bought it on the doji because it confirmed our bullish engulfing, we better not see it close back below the T line and or the halfway point of this candle, because that tells you they didn't break out. They failed. You want to be right back out of that position. So once we see that big price move, we got to remember, this is why I kind of keep reiterating that the bigger a price move, the higher the probability there's been a change of investor sentiment. What chart do you watch? Open daily, 5-minute, 10-minute? No, I'm usually buying off the daily charts. If it goes into the day, then I'll switch to the 10-minute chart and the 5-minute chart. All right, let me see what else we got here. All right, and here's another case where there's times when we get out of the position, but we know we can buy back. So if we know this is our simple rule of a doji, that if we see a doji and they open it lower the next day, close out the position. Is there a possibility that they could do a J-hook? Definitely. We can always buy back when we see that the pattern is confirming versus holding on to something that might be heading in this direction. So this is where we say let the pattern dictate. If we're starting to take profits up here, we don't know whether this is going back to test the 50 or whether we're going to do a J-hook. Once we recognize what type of pattern, we always can get back in. I have no qualms about closing out here and buying back here knowing that each time I was buying, I was heading in the right direction. A doji sandwich, let's see, where was the doji sandwich? We'll find one. All right, and where do we want to take profits? When the probabilities tell us that it's time that things are starting to turn negative. So if we've got a case where we're up in the overbought condition and we're seeing a doji and opens lower the next day, we can close out that position with the idea that if there does a pattern and starts back up, we can always buy back in. So if I saw this type of trading and then saw this bullish engulfing signal, what do we need to confirm our bullish engulfing signal? A positive open the next day. But when they gapped it up and then, or they did a doji and gapped it down, we could always do a double doji situation. But if they keep coming back in this direction, we want to be out of the position, especially when we're up here in the overbought condition. Now, that doesn't keep us from getting back in, but we definitely need to see a close back up above the T-line and then a signal confirmed, which it didn't do here, it didn't do here, but it started confirming over here. Let's see. And what is our biggest fear? I say what is our biggest fear? My biggest fear was closing out of position and then having the price go higher. But why should that not be a concern using candlestick signals? Because we can always come back and get back into a position based upon bullish confirmation. And here's a case where we had it pull back to the T-line. It opened lower, traded down, came back, traded positive. Next day, we can say, all right, if we start seeing positive trading, we can buy back in because we have a J-hook pattern. And here's another case, too, where if it opened positive and started trading positive, and you took the initiative that this was the J-hook pattern, and then the next day they open it back down here, close out the position, because that negated not only the signal, bullish signals, but it also negated the pattern. So this is why I'm showing our entry and exit strategies, knowing or kind of reiterating the fact that all you have to do is learn the simple patterns. There aren't that many. There's only 6 or 8 patterns, and there's only 6 bullish signals and 6 bearish signals. And once you learn them, it's not like you have to do formulas or anything. All you have to do is visually remember them. So anyways, okay. After being here for a few weeks, I see the magic of the T-line. How long have you used it in your trading, and will it lose its effectiveness at some point, like some indicators in the past? Cal, we've been using it now for 4 or 5 years. I was trading successfully in candlesticks for a good many years. And then one of my private training students that came down from Alaska, and we sat in front of the screens for 2 solid days. And he went back, and he was still trying to tweak it, didn't get to it. And then he, about 3 months later, he said, hey, look at the 8 exponential moving average. He said, I've just discovered a very simple rule that if you see a candlestick buy signal and it closes above the T-line, you can stay long until you see a candlestick sell signal and it closes below the T-line. So the nice thing about the Candlestick Forum is because it's all common sense using indicators and the signals, that you don't have to go out and be reinventing the wheel. If somebody comes up with an idea, all you have to do is put it on your chart and back test it or use it. And when I started using the T-line, my profits started growing exponentially because it was keeping me in trades that I normally would have gotten out of and maybe not gotten back into, and it made it much more clear. So the 8 exponential moving average is somewhat like a Fibonacci number. Not many people use it. I mean, I can't imagine I mean, the percentage of people using the 8 exponential moving average has to be so minute that it's never going to be affected. So if more people learn it, I keep telling people, and people ask the same questions about candlesticks. If you teach everybody how to use candlesticks, won't they lose their effectiveness? And I would think statistically that probably 1/10 of 1/10 of 1/10 of 1/10 of 1/10 of 1% of all the people in the world use candlestick signals. We could teach hundreds of thousands of people how to use candlesticks, and it still wouldn't make a wrinkle in any of the markets out there. How long does it take to start recognizing these patterns and some of these example J-hooks that don't look clear-cut to me? Harvey, probably you do a few that produce good profits, and that'll stick in your mind from there on in for a good long while. All right, so if we know that this simple rule is you want to stay long until you see a candlestick sell signal and a close below the T-line, when you can see that you have a candlestick sell signal and it gapping down, our bearish Harami, we've got two alternatives here. One, we can wait to see if it holds at the T-line, or two, and my number one criteria, which is the signal is the first criteria. If I see a bearish Harami and it gaps down and I'm well up in the overbought area, I'm going to take profits with the idea that if it comes back down and holds on the T-line, I can always buy back in. But the signal itself is the first criteria. Remember, the T-line is just a very strong secondary confirmation. And one of the simple rules of our trading is if we're in an overbought condition and we can see them start gapping it up, what's the Japanese rice traders tell us? They tell us that most people buy exuberantly at the top and they panic sell at the bottom. And what causes exuberance at the top? When we start seeing big candles and they start gapping it up. So a very simple rule for a stop loss is if you are in the overbought condition and you see them opening and start trading positive, just put your stop at the previous day's open, because if you're in the overbought condition, the bears shouldn't be able to bring it back down through that level. If they do, that tells you in an overbought condition, the bears are starting to take control, number one. Number two, you can tell exuberance because notice the distance you've moved away from the T-line. We also have this little green line in here. That's the 3T line, which works effectively in conjunction with the T-line in that if you start moving rapidly away from the T-line, then the 3T line kicks into effect. And what we don't want to see is a candlestick sell signal and they close back below the 3T, because if we do, that means they're bringing it back to the T-line. Lori, during the day, they shouldn't be able to bring this trading back down below the previous day's open during the day. So that's where you put your stop. What do the two blue lines represent? The two blue lines. This is the 50-day moving average. This line, these lines down here are the stochastics. And do you ever use stochastic crosses to confirm? No. If you're trading stochastics, that's what you want to do. If you're trading candlesticks, you want to use the signals, and then you use the stochastics as confirmation. And I don't care where they cross. I just want to see whether I'm seeing a buy signal in the oversold condition and if I'm seeing a sell signal in the overbought condition. The green line at the top on the green candle. Oh, one was that I didn't want to see it close more than halfway down this candle, and the other was I didn't want to see it trade at all below the open of the previous day's candle. So those would be my two criteria, that if this had closed more than halfway down this candle, I'm closing out the trade or starting to take profits. If it trades back below the open of that candle, I want to be I want to be out of the trade completely. And yes, don't, Lori, ask the questions, because what I have found is that if the questions you're asking are the questions that other people are thinking about also. I don't use MACD. Now, I have MACD on some of my charts, but I don't use MACD because MACD is a lagging indicator. Now, I have it on my charts because even though I don't use it, it's always a good little fluffy confirmation to see that the MACD is moving in the same direction as what you think your signals and confirmation are moving. Okay. All right, so what are the confirming indicators revealing? I want to know whether the stochastics are in the overbought or oversold condition. Has the price moved away from the crucial moving averages, such as the 50, the 20, or the T-line? And has a signal formed at any resistance level? So again, if I see a sell signal away from the T-line, what do we know about the doji? That if we see a doji in the top, if it opens lower the next day, we want to close out the position. So our first profit taking might be as soon as it opens lower and starts trading down, we close out half the position. The other side is if it comes back down through the low of the doji of the previous day, that pretty well confirms the bears are there. We want to close out the whole position. Let's see. I don't know what this meant, so I'm going to quickly move on. All right. You can also buy based upon, maybe this was what I was looking for. If we see a bullish signal and then it backing off the next day, can we be buying down here? Well, that's where you can go to your 5 and 10 minute chart and you can see if the market, is this the 10-minute chart? You can see that the market opened but traded down here and then started turning around. You can be buying here and maybe getting a better execution down here. And the same scenario with the 5-minute chart. If you see the 5-minute chart start coming back up, that means if the 5-minute chart's coming back up and you're starting to show support on your 10-minute chart, that makes it a little bit easier to be buying intraday. So those are the type of chart combinations that I use. Or you can even go down to your 1-minute chart if you're day trading, and you can see, for example, they pulled back. This is Bank of America a while back. Pulled back, supported right on the 200 moving average on the 1-minute chart, and then started trading positive. Well, if this is starting to trade positive, that means your 5-minute chart is starting to confirm, and your 10-minute is starting to confirm. And you can stay in your trade as long as you don't see a candlestick sell signal to close below the T-line. But even at this point, that may still mean that your 1-minute chart, that your 5-minute chart, although it pulled back, didn't break back down through the T-line, so you can still stay long. There are many moving average lines. No, we've only got a few. The 200, the 50, and the 20. Those are simple moving averages, and then the T-line is your 8 exponential moving average. Just to be clear, the initial stop loss of any trade is on the close, not the intraday. Correct? Yes. But to clarify that, let me see if I can find one. If I happen to see kicker signal, is that the right one? If I happen to see, if I was buying, let's say on this day, thinking I had a doji sandwich setting up, it should intraday, it should not come back down below the low of the previous day's trading. If it does that, you want to be out because that's pretty much telling you the bears are in control. So there will be times, especially on the opening a trade or up in the overbought condition, if it intraday is trading back below the previous day's open, you want to close those out. Let's see. All right. Okay. All right. Let me zip through some more of this here. All right. These are mostly entry. We want to get to some of the profit-taking ones. Here's a case, too. Notice how far away we are from the T-line, and it opens lower. That's not a good sign. That means we've got a possibility of going back this way. This is where I used the previous day's open. So the lower open would have been my alert to get a stop in here pretty quick, that if this is open here, they better be taking it right back up. They shouldn't be taking it back down through the open. Yep, let's get back to some of the stop loss stuff. All right, and here's a take profits. Where do we anticipate? If we're buying down here, we had our dojis, we had the gap up. Where's our next target? Probably the 50-day moving average. This is a case where if I see it get right up to the 50-day moving average, I'll flip to my 10-minute chart to see whether the 10-minute chart is rolling over. If it is, I'm going to take some profits here. Even though it opened here and was trading up and hasn't created a sell signal, I know that I'm getting extended to the overbought condition, and we've already hit our first major resistance level. Go to your 10-minute chart and see what the 10-minute chart is doing. If it's starting to come back below the T-line on the 10-minute chart, you take profits because, again, here's your worst-case scenario. You take profits, and then it turns around and goes back up through the 50. You can always buy back. You've just given up a little bit of your potential profit instead of some of your actual profits. And so this is why you need to see a buy confirmation with it closing above the T-line. A lot of people say, well, if you see this buy signal, can we just go ahead and buy when we see the signal forming? Remember, you want to see it confirm, and the confirmation is bullish confirmation after your buy signal, number one, and number two, you want to see it trading up above the T-line. With it opening lower the next day, that just kept you out of a trade that might not have gotten you, or kept you out of a trade that might have kept you stuck there having to take a quick loss. Okay, let's see. What do we got here? Yeah, so when we start seeing setups, this is why it's very important to see the bullish confirmation going on, coming up through the T-line. Otherwise, if you're in a downtrend, remember, you're in a downtrend until you see a candlestick buy signal and a close above the T-line. If they come up to the T-line and fail again, you just want to stay short. So what we want to do is use the common sense visual aspects of candlestick signals. Now, here's the stop loss meat part. All right. What is the function of stop losses? Well, the number one answer is to protecting capital and keep from taking big losses. That's number one. But just as important, you want to maintain mental control of your trading. And the reason I say that is, what happens when you've got a position that's gone against you bad? Well, most of us sit there. I say most of us. When I say most of us, I'm saying myself, will sit there like a deer in headlights thinking, oh, man, it's down big. I should have stopped out up here. But, boy, would I look stupid if I sold it now and it turned right around and went back up. Well, that's one of the reasons why you use stops, is to get rid of that mental battle in your own head when things are going against you. And the reason it gets rid of that mental process is because if you're looking at a chart in the quiet of the evening or the previous afternoon, and you can say to yourself, this is the spot where this trade should not come down through, and if it does, I should be out of this trade, that when you have that stop and it comes down through and executes your stop, that keeps you from having to sit there and make irrational decisions when you made a rational decision the night before. So just as important as far as protecting your capital, it also protects your mental state, that instead of sitting there saying, what do I do with this losing trade? Do I get out here? Do I wait for it to pop back up? You've got the decision already made, number one, and number two, you have the funds available to put back immediately into something positive. So most of us, again, me, would sit there and say, shoot, what should I do with this trade? What should I do? Is this going to come back up? It doesn't look good anymore. Man, I hate to take a loss. I hate to sell here and have it come right back up. Boy, would I look foolish. It gets you out of the trade at the appropriate time. Now you can look at that chart rationally and say, man, that's a bad-looking chart. And, shoot, I've got my money back in my account. Let me go put it into something positive. So that's the major aspect of cutting your losses short and letting your profits run. So the basic benefit we have with candlestick analysis is that the visual analysis can help us put on logical stop loss situations. If we're thinking about buying here, let's say we owned it and it gapped down and we're thinking, oh man, okay, it's looking like it's supporting here on the 50-day moving average and it opens positive the next day, man, and maybe I'm going to get out of this, but I better put a stop at the previous day's open, because if it comes back down through there, that tells me this gap down is still in effect. So that takes my decision out of this, and before coming out somewhere down here that I'm out of the trade, it doesn't look good, I go find something that looks more like that. And what's our biggest fear of placing stop losses? Our biggest fear is we get stopped out of a trade, and then it turns around and goes right up without us. I say that's our biggest fear. That was always my biggest fear. But now I've gotten to the point where if I take a loss, or if I say, all right, we've closed below the T-line, the only way I can stay in this is if it opens positive and trades positive. If it starts trading lower, I want to be out of the trade. Well, what's my worst case scenario? It goes down and comes back up. Now I can at least see what type of signal it's done. It's produced a hammer signal. And if it opens positive the next day, what's it doing? It's confirming that this is a hammer signal, bounce, and we're back up above the T-line. I can afford to close out here and buy back up in here, knowing that when I bought back, I was heading in the right direction. Someone suggests buying a put instead of placing stop. No, that's not the trade. Your trade, Bill, is that you're anticipating this is going up, and not every trade, as we can see, that sells off is going to be a good put trade. The worst case scenario in this case is that you stop out, it comes back up, and it continues the pattern. When a pattern that we can identify, a J-hook, we can always buy back in. Anyways, yes, to buy a put on something that's turning over, we're not buying this because we think now it's going down. We're closing out a position that we don't think is heading in the right direction, as what our initial analysis was. There's going to be much better situations out there that probably be analyzed to be a put situation. So we use the simple rules and visual analysis. Our biggest fear of getting picked off is eliminated because we can get out of a position, and I keep stressing that it takes 7.3 seconds to type in that signal or the symbol, the amount, and hitting the buy button and be back in again. Does this methodology apply to Forex? Yes. This is not a methodology that works for stocks or commodities or tulip bulbs. This works for any trading entity that has fear and greed in it. So we should be able to put our stops because we know that candlestick signals have expected results. If we're trading up here and we're getting indecisive, where is a logical place to tell us that this is not moving in the right direction anymore? Well, if we see kind of a doji right here on the T-line, it shouldn't trade back below this area because that would be confirming the sellers after the doji number one, and would be bringing us back down below the T-line. If this is the bullish confirmation, where the bull's trying to take control, and it fails, we don't want to be in it. What was our failure of confirmation? Number one, the signal. Number two, the T-line. If we have a signal down here and they gap it up, what's that tell us? Well, we've got a much stronger signal of potential flutter kicker setting up, and we've broken this resistance level. So the low of a doji is a very good point to put your stop if it's up in the overbought area and it's right in the T-line area. If it came back down below this level, where was it going to? At least back down to the T-line. Exactly, Kristen. The commission should be irrelevant because we're not buying these trades, or at least on a swing trade, we're not buying the trades so that we can make 3, 7, 10, 15, 20, 40 cents. We're usually trying to buy a position where if we're buying it, we're going to make $3, $4, $5, and if it costs us 20 cents of insurance not to be in every part of that uptrade or uptrend, that's that much better for us. And this is why the halfway point is very important in Japanese candlestick analysis. If this is the candle that told us the bulls are in control, the bears shouldn't be able to close it back below this level. Plus, you see that happen and close below the T-line, close out the position. Remember, we're playing the probabilities of what normal human reaction does, which means if we see a buy signal in the oversold area, it shouldn't be moving in this direction. It should be moving in this direction. And if they're moving back in this direction, that signal was part of that 30%. So let me skip down through here because we're getting. Anytime I start seeing gap up in the overbought condition this far away from the T-line, I have my stop at the previous day's open. So the very simple part of this type of analysis is, what should the trend be doing? Why did we analyze which way it should be going in the first place? And what should it be done when it alters that trend? So if we're looking for something like this and they gap it down, that's not going in the right direction. That tells us if we see any weakness, close out the trade. All right. Mercy sakes, we got tons. So I kind of getting off topic a little bit. Over the weekend, I was telling everybody in the chat room today that I got one email from somebody saying, I've followed your picks for the last 36 picks, and 12 of them are up, 9 of them are down, and some didn't execute, and 5 are still open. I said, that's not a real good track record. Well, this is what we're trying to teach people is we're not trying to create a track record where 100% of your trades are going to be up or all of them are going to be up. What we're trying to let people know is even if we're doing well, we'll have 70% winners, but we're also going to have 30% losers. So that means every trade you put on, you've got to decide what should we be expecting from here and what should we not want to see if this is a buy signal, coming back and closing here. So the visual capabilities we have with candlestick signals just allow us to decide where we want to be in, where we want to be back out of a trade. There's always going to be situations where everything looks good, but when it reverses, well, the biggest mental problem most of us have, and again, me, is, man, this is a good trade. There's my little flutter kicker. This is a strong signal. It's hard for me at the end of the day to say, man, this didn't work, close out the position, because that's the part of the ego part of most of us, or our emotions, is if we take a losing trade, our ego says that we're losers, we're bummers. That's not good. And that's the way I always thought before candlesticks came along. But then I realized that 30% of our trades aren't going to work. Close out the position if it's a failed trade. All right. Again, putting our stop losses in, the most important aspect, as well as keeping our profits in or keeping our equity secure, is keeping our mental process clear. So Again, we've just done gaps at the top and using the T-line to help evaluate that. The other day we had people saying, should I be buying here? And this is where the elements of a daily chart as well as your 10-minute chart tells you, yep, they're not selling this. Is this still a buy with it closing below the T-line? Well, if we can go back and near the end of the day, it's still looking like this, where they're closing near the top end of the trading range after gapping up. That tells you want to stay in the position for the next day. We also had some very good profits in VISN, but where do we start looking for taking profits? Well, we started seeing the parabolic move, and on this day, with it above the T-line, well above, or the 3T, well above the T-line, was it time to take profits? Well, during the day, meaning the first hour and a half, it went up, and then it came back down through the T-line. We sold out the position. But notice what it did a little bit later on the 10-minute chart. It came back up above the T-line, which told us they weren't selling this anymore. They were still buying. We bought right back in. So we already had some very good profits on this trade because we were buying down here. We closed out the position, bought it back, and then just the next day, when it did a sell signal back below the and traded back below the T-line, we took our profits again. So what the signals basically tell us is when there's been a change of investor sentiment. A lot of people say, is this too high to buy when they gap it up like this? Was it too high here or here or here? Again, you use your 10-minute chart to say, well, they aren't really closing this back below the T-line, and there's points where they're still buying. You could be buying this one on positive trading. When there's always times, too, when you want to be closing out a new trade, we recommended GALT the other day. It opened positive, got some people in, and then closed down here. The first thing you need to say to yourself is, this moving in the right direction? No. Worst case scenario is that you close it here. You can always buy it back if there's bullish confirmation the next day. We've had SEM repurchase in it here with the flutter kicker, but today it told us that they did a left-right combo. Is this a bullish chart? Definitely not. We close out the position. All right, we came out flat or took a small loss. I'd rather take a small loss than take a big loss from down here. And why do we have portfolios of trades? Because we are going to have days where something that looked like it was going to be profitable is selling off. But if I've got 10 positions on, and I own one position like this, and another position like this, that loss in that one trade is well being offset by gains of high probability situations on other trades. I'm going to have trades like this where I have strong days, and then for a couple of days I'm not sure, but I'm not really concerned because it hasn't broken my uptrend. So when this is lollygagging, hopefully I've got some other trades that are working like this that are offsetting a lollygagging day, and it makes my decision that much more less emotional. Is that I'm still buying, or I can still hold something, knowing that it hasn't done any sell signals, just not moving in the right direction on these past few days. If I've got a sell signal and it opens lower the next day, I can close out the position. If it goes down and comes back up, I can always buy it back knowing it's heading back in the right direction. And this was the hardest part for me to get acclimated in my own mind, because prior to candlesticks, if you sold out something, most people didn't have any format or any trading program to tell them that it was time to get back in. Just ego told us that we don't want to get back into that trade. Now at least we have a visual format to say it's time to get out and it's time to get back in. So again, the nice thing about candlesticks is there's no formulas, there's no price percentages that we have to put stops. Just use common sense visual analysis. Okay, now let's go. If you asked a question before and I missed it, Going back up here, we'll start again. Place a trailing stop in an uptrend. Yes, again, the simple spots for most of them is that each day I put a stop at the previous day's close, or if I got a hammer signal like this, I don't want to see it close back below the previous day's low. And if it's trading like this, again, the longer we're in an uptrend, the more compelling it has to be to stay above that T line. Why do you use the 34? The 34 is on here mostly for commodity trading. It's not very effective, or not as effective for the stock trades. Usually the 20, the 50, and the 200 are more effective for the stock trades because that's what all the money managers are using. Never place a stop, or never place a stop, place a trigger alert. If you get the alert, look at the 10-minute chart to see if that's truly the time. Yes. Yes, there's going to be a lot of times where even on your 10-minute chart, you see a pullback, but it's not coming, it hasn't closed below the T line. You just stay with it. Yeah, you can, once you get, especially in a positive overbought condition, you adjust your stops daily. Are you out of VXL? No. Or XLY. Where did I get VXL? No, I didn't close out anything today, only because I don't think today was anything that was really earth-shaking. I'll give, and it's not even coming up here. And this isn't going to work either. XYL didn't close below the T line. GTI, yes, I am out of, but I will be buying this one back based upon, again, this sell signal right here was a reaction to let's see, I can't, maybe I can. There we go. This was a reaction to a downgrade. That does not change the investor sentiment. That's just supply and demand from one group. If this does a J-hook type pattern, I'll be buying back this, because what do we usually see after a fry pan bottom situation? Oops. We usually see a lot of whipsaw action. And usually the whipsaw action, even if it pulls back, they will send it right back up again. Yeah, we won't be able to do individual stocks here. Do you put in a physical stock after you've entered a trade, or do you only put in a physical stop after a sell signal or a stock looking soggy? When it starts looking soggy, yes, I'll have a stop in. If I buy one and I'm still sitting here, which I am most of the time, I won't put in a sell stop unless I start seeing it start moving back in the wrong direction. There's candlesticks and formations that have more reliability than others? Cindy, not necessarily, because this month, if the market's moving up, it might be that the hammers are the stronger signals just because of the nature of the market. Next month, it might be dojis at the bottom after a pullback, or a shooting star at the top. But I do have a video out on the signals quantified, which tells you which signals and patterns usually work the most proficiently most of the time. And for example, the number one is the doji followed by a gap up, your best friend. Right behind it is the left-right combo. These occurring mostly in the oversold condition. So there are, I do have some quantified, and all those formulas are on Metastock right now that if you have Metastock charts, you can download all those and have a kind of a list of which ones to look for. And that's going to be one of our processes when we do the scanning on February 1st. We're going to first go through which signals and patterns are the strongest, and then how do we set up the scans and look for those. You give daily buy recommendations. Why don't we get daily sell recommendations? I do try, because there is one very simple sell recommendation. If it closes back below the T line, close out the position. And right now, with the market in this uptrend, that's your basic sell recommendations. How long do you follow a stock you are stopped out for a possible re-enter? Oh, Sharon, I've got watch lists, which again we'll show when we do the scanning. That if I come out of a position, I'm not going to close it out right away because there's still some possibilities, like a J-hook type pattern, or like we see in this chart, where if I closed out here, I didn't take it off my chart because I knew we were coming out of a fry pan bottom. We might have this whipsaw action. So it's going to stay on for the next day or two. But, for example, if it sold out here and came back up and the next day it sold out here or closed down here, that told me, this one's dead. Probably after a couple of days it'd come off the watch list. Marie, the portfolio is each person's portfolio, not necessarily, because what we're doing is we're recommending 2 or 3 stocks each day, and the ones that do confirm, I mean, I might be recommending 3 stocks on any given day. For example, today we recommended 3 and only 1 actually created a confirmed buy signal. And it's not so that you buy every signal, because it might be that if, in my case of doing portfolio management, if I've got a portfolio or my trading portfolio has 10 positions in it, on any given day, maybe one of those is ready to be sold. So I may not have bought any of the recommendations for the last 2 days because none of the positions I had in the portfolio were ready to sell. But now I've got one that's ready to be sold. Now I've got a supply of 3 recommendations. Or the reason I try to teach people how to do their own scanning is because of the logistics. I may be putting 3 recommendations out tonight, and tomorrow none of those 3 open. But if you've done your scanning process where you had, on one of your lists, you had 7 good picks and the 3 that you picked out didn't open correctly, there were still 4 more that had good possibilities of being a good trade, that you want to use one of those. So that's why we try to teach people, teach everybody how to do their own scanning and then analyze which ones look like the best. So if something doesn't open like it should, if you thought that was your best trade the next day, you had some others to go look at. Do you put on stop losses every morning? Is that for the trading day? No, not necessarily. On the open, I'll see if something's open incorrectly. I'm going to close it out immediately. Then if I see things start moving, and say, for example, let's see if I can do this correctly. We bought Pran the other day, and it did exactly what we expected it to do, a doji sandwich. Well, once it opened and started moving up, it was just simple enough to put a stop loss right here, because if it was moving up, it shouldn't come back down through the open. If it did, it was telling us they weren't going to break out. So now I look and say, all right, where's my logical spot tomorrow? If this opens higher and starts moving higher, I might put my stop right here. It shouldn't come down through the halfway point. And then if during the day it moved up big, then I'd probably move my stop up to the open of that day. The reason I put my stop up to the open later on is because if it moved big and came back down, that tells me it'd be doing a shooting star type signal. Can you summarize when you use intraday stops, oversold, a distance from the T-line? If I am a good distance away from the T-line, let me go back to let's see if I can use one of these as an illustration. If I'm a good distance away from the T-line, I'm immediately going to my 10-minute chart to see what my 10-minute chart is telling me. And when it comes back down through, I know I'm already a good distance away from the T-line. I should be a little bit weary about whether it's going to come back and test it. So if I close it out here, I'm anticipating at least a 10-minute chart coming back to the 50. But when they turn around and come back up through the T-line, I can always buy it back. Now I don't know whether I answered the question. So that's my intraday stop is once I open it up and I'm watching my 10-minute chart, I might have a stop, but it shouldn't come back down below the T-line. If you miss the sell signal and drop below the T-line, do you have recovery management techniques? Yes. If I miss out on a trade that I don't let's say I bought this here and I wasn't watching it to close down here, and I still own it at the close. Now my management decision is this better open positive and trade positive for me to stay in it. If it opens lower, close out the position immediately. Let's see. If you miss, for picking entry points, what do you think about opening range breakouts as long as candles, moving averages, and indicators agree? Yes, you buy immediately. Sometimes the gaps are too big, so that's when you flip to your 5 and 10-minute chart. But if I see a positive open, and let me think of, if I'm thinking about buying this on a positive open, if it opens positive the next day, and it after 2 or 3 minutes is still moving positive, I'm going to buy it because it's telling me they're doing exactly what I expect after a doji, moving up in the direction of how they open it, number one, and doing a doji sandwich, number two, and number three, they've broken out through this range. So I'll buy fairly quick. What are the time frames that you place trades on? Most of the time, Phil, it's going to be on the daily chart. If I saw this open positive and start trading positive, I'm going to be buying it based on the daily chart. But if this opened lower and started trading down, and let's say it hit the T-line and started bouncing back up, then I might go to my 10-minute chart and say, all right, all this did was come and use the T-line as support. Maybe I can buy it a little bit cheaper as it's moving back up. Okay, all right, I've kept you over time. If there's things, do you use mental stops most of the time after you've entered all your trades? Most of the time, Sam. And I'm usually here for the first 2 hours of the trading, first 3 hours of the trading. So if something opens up and then starts going negative, I'll watch it to make sure that it's just profit taking versus that there was the continuation of a downtrend. And then if it did come back down to, let's say, the low of the candle that told me the bulls were in control, I'll close out the position. Do you hold through earnings? Yes. Remember, the candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame. So if they're still buying going into the earnings report, that they know there's an earnings report coming, that means somebody probably with a little bit more knowledge than I have about what's going on in that with those earnings are buying. That's still a buy signal. We may not, any trade that we buy, we may not have any, I don't have any reason why they're buying CADX. As a matter of fact, I pretty much don't even know what CADX does. I figure it's a biotech of some sort with the X on the end of it. But all I can see right now is they're buying, and that's all I'm concerned about. Where do we find candlesticks reliability video on the site? Not reliability, the quantitative one. It's there somewhere. If you go to products and services, I'm guessing there's 40 or so videos. It looks like only the most recent 5 recorded chat sessions are listed on your website. Is that correct, or are there more? Marty, I'm sure there's more, but just because of the space Yeah, they probably disappear after the fifth one. If you had a $20,000 account, would you recommend 10 $2,000 positions or 5 $4,000 positions? Probably 5 $4,000 positions, just to make sure that you're not getting eaten up by commissions, which aren't very much. But I'd rather have 5 positions on than 10 positions. Yeah, if you can't find something on the website, just email Abraham, and he'll get it's a candlestick for him. There should be an N in there. Phil, when I'm trading commodities during the day, like hogs or soybeans, I'll use the 10-minute chart as my bellwether, and when that looks like it's setting up, I flip down to the 5-minute, and if that looks like it's setting up, then I flip down to the 1-minute, and then make sure the 1-minute, 5-minute, and then the 10-minute are all confirming. Okay, everybody have a good evening. Let's see, we're going to be next Tuesday night, for those that are more interested in the option side, we're going to show the benefits of option spreads versus just buying outright calls or puts. And then again, on the February 1st, we will be doing scanning. That's usually a longer one. That's going to take about 2.5 hours. That'll be on a Saturday morning. And so just stay in your pajamas and slippers and bring your hot chocolate, and we'll do a session then. All right. Calls are on Tuesdays instead of Mondays now. Calls are on Tuesday. Calls are on Tuesday. I don't know what that means, Cheryl. Calls are on Tuesdays instead of Mondays now. No, we're just doing this session. No, the free ones for members for these specific topics, so just the next couple of Tuesdays. We'll still have our Monday night sessions. Okay, everybody have a good evening. We'll see you in the chat rooms. The scanning session is Metastock TC2000, but it's simple enough that you can put the formulas in any one you want. Thinkorswim, I think the formulas are already over on TradeStation. And in the chat room, we have enough people like Ed C. that if you need to know how to put the formulas in Thinkorswim, he's got all the formulas set up for you. The 3T is ready. I don't know where it is. Tim's got it. Pat will be coming out with some sort of announcement for everybody to get that one. All right. Have a good evening. We'll see you tomorrow.